Welcome to All About Money on HKIBC. I am Chloe Fong. As COVID continues to cause global disruptions, many companies have changed their working style, shifting to the work-from-home model to cut costs. But the new normal has led a 19-year high vacancy rate in the office real estate market. Empty Grade A office space is now equivalent to 170 football fields. But my guest today believes there are still opportunities in the sector for both investors and tenants. Let's now bring in Marcus Chen, the Executive Director and Head of Research of CBRE Hong Kong, to analyze the city's office market situation. Welcome to the show, Marcus.
Hi, Chloe. Thanks for having me.
And actually, I know that from last year, you have already been warning the surging vacancy rate in the office market. But now the situation seems to be worsening. So can you first just run us through the situation as well? We can also get a brief review of the H1 performance, if that's okay.
Sure, Chloe. You're absolutely correct. The office market, it's having a very significant or very high level of vacant space at the moment. So in terms of percentage, it's getting very close to 12% of the total stock in Hong Kong. But if you translate this into square footage, then we are now at about 9.8 million square feet. So like I said before, this is an all-time high in Hong Kong's history. And it's not really just focusing on any particular submarket. It's basically quite across the board, across all the major office submarkets in Hong Kong. Central CBD, it's actually a little better with vacancy rate at slightly below 8%. But other than the central CBD, basically all the other major submarkets are having double-digit vacancy levels at the moment.
Right, and I just want to focus on the districts that has most concerning vacancy rate at the moment. So we know that the Kowloon East is the highest, which is currently standing at 14.6%. Can you just give us more details on this?
Of course. 14.6%, it's, of course, it's the highest across all the major submarkets in the office market. However, this is nothing new because even before COVID, even before the social unrest in 2019, Kowloon East is the submarket already with a double-digit vacancy level. So landlords over there, they are getting used to such a high vacancy level even before the economic recession. So it's nothing new, but instead, if you look into other major office submarkets, such as Wan Chai Causeway Bay, such as Tsim Sha Tsui, or even in Hong Kong East, down at Quarry Bay, then the vacancy levels have been climbing very, very steeply over the last 2 to 3 years' time. Before COVID and before social unrest, most of these submarkets were running at low single-digit vacancy levels in the range of 2%, maybe 3%. But now, like I said earlier, all the vacancy rates in this submarket are reaching double-digit levels already. So the pressure, although it's quite high in Kowloon East, but what surprises landlords are the vacancy levels in all the other submarkets.
Right, got it. And there are obviously still some remains in the market as well. So just tell us, what are the main drivers for the remains from your perspective?
It's basically, a combination of a couple of reasons. I think, first of all, Hong Kong has been running, at a recession over the last 2 to 3 years' time. And then, COVID definitely has a lot of disturbance to business momentum and to business practices. So for these reasons, a lot of the businesses they prefer to work from home under the COVID situation. And then on a cost-saving perspective, a lot of the business operators, a lot of the businesses, they also try to find a lot of ways to save operating costs. And on this reason, downsizing or downgrading the office premises have become, very popular.
Right. Actually, previously, we've seen some companies, they are trying to, relocate to some decentralized areas, for example, at Quarry Bay. But now, do you think, given the surging vacancy rate, the companies, they can try to move back to the CBD area, to take advantage of the lower rents?
Right. We have not seen too many companies moving back from decentralized locations to central. I would argue that this is not a common trend at the moment. But what is also true is that landlords in central or landlords in other major office submarkets, they were trying very hard to retain the tenants within their portfolio buildings. And in that sense, they are offering very competitive rental packages. And also, you've got to understand that the relocation costs from one place to another is very high and has been very high. So reinstatement costs of the existing premises, as well as the capex or the fit-out costs in the new premises, they're very high at the moment. So if you take into account all this, and if you also take into account the narrowed rental gap in between the core office submarket and the decentralized office submarket, then that explains why tenants are trying not to move around, despite that there are more options out there in the market. Whenever there is possibility, I think many of the tenants, they chose to stay at the premises where they were.
Got it. And also, I'm thinking, how long do you think it will take for the market to absorb this, huge amount of office space? What's your view on this?
Oh, okay. That's an interesting question. Like I said before, office vacancy is a very, very high level at the moment. We're talking about 9.8 million square feet of available space out there. And if you consider the average absorption rate, as well as the average vacancy level in Hong Kong, in order for the market to bring the supply pressure down from the current level all the way back to a so-called long-term average or long-term healthy vacancy level, our estimation is that it will take at least 3 to 4 years' time for the market to absorb much of the space in the market before the market can, goes back to a more stabilized level. And not to mention that, on top of that 9.8 million square feet of existing vacant space in the market, we are going to see a very substantial supply boom in the next 18 to 24 months. Basically, in 2022 and 2023 combined, we shall expect to see another 7 million square feet of new space entering the market. So I reckon, it will remain largely a tenant's market, at least for the next 3 to 4 years' time.
Right. Just very quickly, following your previous point, what rate will be healthy from your perspective?
Okay. On a very long-term perspective, 4 million square feet, it's basically the threshold. So, like I said, we're now at 9.8 million square feet, getting very close to 10 million square feet already. So the market basically has to absorb roughly around 6 million square feet in order to, go back to a very stabilized situation.
Got it. And also, let's talk about the rents. I'm wondering, how have the rents been affected following this trend? Which district are you mostly concerned about at present?
Right. Office rents have come down by roughly around 25 to 30% since the peak in 2019. So that's basically the situation for the last 2.5 to 3 years' time. The decline varies between submarkets, with the core submarkets such as Central CBD, such as Wan Chai Causeway Bay and Tsim Sha Tsui. These core submarkets have rents largely come down by 27, 28%. Some may be getting closer to the 30% mark. However, in some decentralized submarkets such as Hong Kong East and Kowloon East, they started to fall slightly later than the than the core submarket. So from the peak all the way to now, Hong Kong East, Kowloon East, this kind of decentralized submarkets, we have seen rents coming down by about 20 to 23% in the year to date.
Got it. And also following that, there are some reports saying that the lowered rents in Kowloon West or Kowloon East, actually some argue that it's mainly in Kowloon West because, the city is also trying to develop the West Kowloon Cultural District. So this could attract more Chinese firms as the office rental gap between the Greater Bay Area cities and Hong Kong has been narrowed. So do you agree with this forecast and why?
Although I would agree that West Kowloon Cultural District or the areas nearby, it's going to have a very good potential in the long-term future. But I think imagine if the border gate is going to reopen sooner, then if the Chinese demand, if the PRC companies will come back to Hong Kong, I think Central CBD will still be their number one preferred location. So I think, if travel is going to resume gradually between Hong Kong and mainland China, I think the Central CBD is the first submarket that will benefit from the inflow of Chinese demand.
And why that?
It's basically a preference. So far, if you consider the trend in the last 5 to 10 years time, when Chinese companies they have a very strong influx into Hong Kong. For most of the time, for most of the companies, most of them they prefer to be in Central. And I think Central, it's basically the premier CBD in Hong Kong, and it's very reputable across the whole of mainland China and across the world as well. To a very large extent, Central has a high concentration of the government departments. The government headquarters is in Central. The High Court is in Central. The Hong Kong Monetary Authority, for example, is also in Central. So there is a high concentration of banking and financial sector firms in Central as well. So very logically, I think a lot of the tier one companies from mainland China, they would also like to be in Central.
Got it. Thank you very much for your thoughts, Marcos. Let's take a short break. Coming up next, we will have more analysis on the office market as well as the city's commercial real estate market. So don't go away.